Hey everyone, welcome to this video where I'm going to be sharing my opinions on the bearish arguments facing the stock market today. If you haven't already seen my last video called Stock Market Recovery or Collapse, be sure to check that one out because in that video I present all the arguments and explain each one of them. You'll be able to find that video in the description below. I want to make sure that everyone is able to formulate their own thoughts about the subject before hearing my opinions. In this video, I'm going to briefly share my bottom line opinions on each of these topics, and in future videos, I'll break some of these concepts down to share why I ultimately came to these conclusions. With that being said, let's get right into it. I'm on a wave, slept on, now I got next on. I'm on a wave, I'm on a wave. The first bearish argument is that the stock market is overpriced. I do think the market is extremely overpriced, and I think this is very bearish for the stock market, and let me share why. So in my last video, I shared a chart of the ratio between the Wilshire 5000 and GDP. In this one, we can see the Wilshire 5000 or the total market cap in blue and GDP in green. I personally believe that GDP is one of the most accurate measures of the true value of the stock market. And so if we look at GDP being at around 21.5 trillion and the total market cap being at a little over 32 trillion, I would say that given this measure, the total market is at about 10.5 trillion overvalued. So if we look at this as a percentage, I would say that the market is conservatively at about 30% overvalued. And so personally, I wouldn't even think about investing until we at least came back down to this green line, which represents the value that our nation is actually producing. The second bearish point is the US debt crisis. In my opinion, I think this is a huge deal. However, its impact on the stock market is just going to be a symptom of the larger issue. And so I think the main focus should be on how our country is going to be impacted, how our currency is going to be impacted, and how our standard of living will be adjusted because of this massive accumulation of debt that might end up manifesting in a solvency issue where the US can't even service the interest payments on the debt. If solvency ultimately becomes an issue in the near term, then the entire financial economy would collapse, and it goes without saying that the stock market would collapse with it. The next argument is that we're in a liquidity trap. I personally believe we already are in a liquidity trap. There would be massive short-term consequences if the Federal Reserve raised interest rates or lowered interest rates from where they are right now. After the Federal Reserve lowered interest rates from 1.75 to where they are now at 0%, they were not able to achieve any significant change in consumer spending. And so therefore, I believe we already are in a liquidity trap. The next bearish point that I'm going to cover is that the stock market is disjointed from the economy. I completely agree with this statement. With the stock market being at all-time highs and consumer debt like credit card debt, student loan debt, car loan debt, all of those are at all-time highs, while also our national debt is continuing to increase at an alarming rate. This does not represent a healthy economy. While I acknowledge the divergence between the stock market appreciating and the economy deteriorating, I don't necessarily believe that this will have a short or even medium term impact to the stock market alone. In theory, the stock market can continue going up no matter what happens to the economy as long as the financial economy is continuing to churn up currency to artificially inflate prices. The next bearish argument is concerns about the pandemic. Of course, I think this is a huge deal. And the main reason why I think this is such a big deal is because of the impact to consumer psychology and also the impact to small to medium-sized businesses, the root of the real economy, and how these businesses and employers are going to be impacted by this change in regulation and expectation and being able to run their business. If small businesses have to continue to lay off employees and ultimately shut their doors, which many already have just from this first shockwave and the mere uncertainty of the future. And we remain in this environment where the economy is kind of second priority and we act like we can just turn it right back on and get back to normal, then I think that we are in for a brutal awakening. The next bearish argument is investor overconfidence. I definitely think this is an important point to understand because the whole point in investor psychology is understanding where you are in a trend. If people are super confident, then that's probably not the right time to buy because it's overbought. If everyone is really fearful and no one's investing, then that's probably the right time to buy because it's probably oversold. However, looking at investor confidence alone, just like looking at the economy being disjointed from the stock market, It's an important observation, but alone it can't stand as a big reason for the market going down in the long term. So in my opinion, I think this is very important, at least from a short to maybe even medium term standpoint. However, I don't think alone this metric can be a deciding factor on whether or not you think the market is going to go into a depression. The next bearish point is concern over the US China trade deal. In my opinion, I think this is a valid concern. And if a trade deal were to fall out, I do think there would be a very severe correction in the market because a lot of investors would be just very scared about that news. However, the US and China are very much benefiting from their current trade relationship. And so if that trade deal were to fall out, I think there would be much bigger concerns rather than just how that'll impact the stock market. In my opinion, regardless of the fundamental factor, I think this and many other things could be the precipitating factor that would shatter investor confidence and would ultimately bring the market back down to reality and to fair value. The last bearish point is high unemployment. When looking at the relationship between unemployment and the stock market, the main fundamental concern is when people are unemployed, they're making less money. And when they're making less money, they're spending less money. And when they're spending less money, there's less consumer spending, which is one of the driving factors for GDP. And so when people aren't spending as much money, the economy is not doing as well. Companies aren't making as much money. And so this impacts the stock market. However, with all the stimulus and people getting unemployment benefits and stimulus checks, people are getting the money. However, they're just not choosing to spend it as much as they were before because of all of the risk in the economy right now and all the uncertainty moving forward. So if unemployment were to go up to 25, 30, 35%, this would be a massive concern. However, I don't think it would impact the stock market directly the way other people might think because people are still getting money. They're just not choosing to spend it. So whether they get it from their job or they're getting it from unemployment benefits, they're still getting that money. And the problem is that people aren't spending their money because they're concerned, and rightfully so. So that wraps it up for my opinions on the bearish arguments facing the stock market today. And be sure to check out my next video where I'm going to be sharing my opinions about the bullish arguments that I talked about in my last video. Thanks so much for watching. Let me know what your thoughts are about my thoughts and your opinions in the comments below, and I will see you all next time.